All right, the recording is on. We'll let everybody get their lunches and cups of coffee and whatnot. Welcome to the weekly Camera Plan webinar where we explore ways to build wealth using and to cut taxes too. Forget that, using
Yeah.
IRAs and 401ks. And so everybody's getting settled. We're lucky enough to have Ada Katina, one of the founders of Sequoia Fund Group, with us today to talk about the role that alternative assets can play in diversification. Diversification means a lot of different things to a lot of different people, but definitely alternative assets can play a significant role in this. So before we get started, and we're going to have Ada's slides up here real soon, is the usual disclaimer: the lawyers always have to be involved, and we're not here to provide any investment advice, and we can't endorse or recommend or promote any kind of investments. So everything you hear here is for educational purposes only. We're not advisors or CPAs or realtors or attorneys, and so we can't give out any of that kind of advice. And we always advise, I probably repeat it in my sleep, that anytime you do anything on the alternative investment side, anytime you do anything significant in investments, consult your tax specialist, your CPA, your accountant, your significant other, everybody that you need to before you do anything. And so with that out of the way, I'm going to unshare. And Ada, let's see if you can
Thank you.
pull up your slides. Welcome.
Okay, thank you so much. Before I share, let me just give kind of the 30-second, here's who I am and why I'm
Please
qualified to
do.
talk about this. So I'm Ada. I am one of the founding members of Sequoia Fund Group. And myself and my business partner, we started this fund because as strategic financial planners, we utilized alternative asset classes with our clients a lot. And we started kind of discovering some bottlenecks and some issues. And so this fund was the brainchild of those. And we'll kind of talk about those, right? The barriers to entry. How do you find the good funds when you start getting to diversified and now you're needing to track all these different logins and the different returns and the different K1s, and right, how do you keep everything clear and straight? How do you make sure you're getting into the good opportunities? If you only have 500,000 to invest, how are you making that decision if you have, you know, one that wants 250 and one that wants 100, and now a large portion of your portfolio is only in two investments, right? And so really kind of breaking through some of those. So that's who I am. Let's muddle through this sharing process, see how it
There should be a
goes.
button in the tool tray at the bottom.
Yeah, I'm
And
gonna see if I can
there you
go into
go.
slideshow
Slideshow
mode.
mode. There we go.
All right.
All
Okay,
right, you're
awesome.
on.
So
Fire
Sequoia
away.
Fund Group. Sequoia Fund Group is a customizable fund. So we'll get more into what that means, but that's all at the end. So let's talk about the resilience in your portfolio, right? Alternative investments can really help to build the resilience in your portfolio. The question you need to start with is, do you have all of your eggs in one basket? If you ask someone who is in the stock market, they're going to be like, oh yeah, I'm super diversified. I have 200 different stocks. Okay. But all your eggs are in one basket. And on the flip side, you might talk to someone who's big into the alternative space, right? We're all here through Camera Plan. So obviously, like, you're either well invested into alternative assets, or you said, I want to get out of just stocks. I don't want to have all my eggs in one basket. But on the flip side, you can have someone who's all in real estate. Well, guess what? You're not in stock. The stock market goes up and down and your portfolio doesn't change. But when there's something dramatic in the housing market, like interest rate changes, now suddenly we see the spectrum of real estate, anything that's using leverage, is being impacted, right? So are all your eggs in one basket? Because if you drop that basket, whatever basket you are carrying, if you drop that one basket, you will have eggs getting broken. Okay. So most people think about investing in terms of stocks. So I'm going to relate this back several times because it is what most people grew up hearing about. And I think it's the easiest thing to relate to. I added this slide in because yesterday, actually, I had a really interesting conversation with someone who said, you know, the stock market is the place to be. Taxes have only gone down in the last 20 years. And this is how you make money. Don't listen to all those people that tell you to do otherwise. So I pulled up the history of taxes and I said, well, actually, that is a pretty clearly inaccurate. They've gone up and down, but overall they've gone up. Let's look at stocks. So if you look here, right, in that first line, from 1928 to 2024, stocks have outperformed real estate. That's true of actually any period that's examined here, right? I didn't do this research. This is from Investotopia website, but here you go. So if you want to grow your portfolio based on these numbers, you'd want to be all in stocks. Okay? But there's more to the story. Because if you look here, we can see we can see the S&P, which is sort of the blanket general stock market, and real estate, that blue dotted line. So I don't know if you can see my mouse on the screen, but imagine that you retired in 2006 and you were fully in stocks. And then you were 2 years into retirement in 2008. You'd be going to Walmart every day submitting an application, right? Or maybe you said, oh man, I rode that out, and you retired in 2009. And you're thinking, I am so smart. I waited 3 more years to retire. God, I'm just so good at this investing game. And then we had 2011, right? So overall, yes, in the history of the stock market, you can say, well, it's outperformed real estate. But however, let's look at that same time period, right? So if you retired here in 2006, yes, your portfolio would have gone down if you were fully in real estate, but it would not have gone down as much. Same thing. You think you've survived, you're retiring over here, the market's back up. And now we're seeing 2011 happen. People who are fully in stocks are suffering again. And you've taken just a tiny little bip down. Really, your portfolio is almost the same as what it was 2 years before when you chose to retire. Okay. So now, does that mean that real estate's the end all be all? No. But it does show you if you just were in these 3 asset classes, you could really change the experience of retirement. So common mistakes people make is being too heavy in one class, right? Whether that is fully in stocks, whether that is all in real estate. If you are fully in real estate, that's not really a plan. That's just putting all your eggs into one basket. Or if you're all in any other one stock, right? They all have, or one investment class, sorry, not stock. Because you need to find the balance of liquidity, the balance of income versus growth, the balance of geographic locations. If you're all in houses in Florida, right? That's even if you're all in, I'm in commercial real estate, I'm in residential, I'm in mortgages, but it's all in Florida, right? Here's again another level of not being super diversified because of the geographic impact. And oftentimes people think, well, I'm not near retirement, so I don't need liquidity. Which, if you have enough savings elsewhere and you know I'm never going to have to touch that until I hit retirement, I'm in my 30s or 40s, okay. But what happens when you see a deal and you think, oh, that I have so much faith that this is going to grow into something in the next 20 years. I want to get in on that. And you're all in illiquid investments. Then you just get to sit back and watch that Apple stock go up and think, man, I could have been rich, right? You want to invest in Bitcoin in the early years and you are all in on it, you don't have any liquidity in your portfolio. So balancing some liquidity. Now, how much you need is going to change depending on where you are in your journey, but making sure that there's some, because unforeseen events happen, right? And sometimes that's just that unicorn investment you want to get in on because it aligns with your goals, your beliefs in the future. And then understanding the structure, the risks. So I have found more often than not the understanding of like what is debt, what is equity, and how that it impacts but does not really dictate the structure of the deal. So you can have an equity deal that is not liquid, that is not income focused. You can also have an equity deal that does have a good amount of liquidity in it and has is income focused or is a mix of it. Same with debt, right? If you're in a mortgage and that's you're financing mortgages, there's really no liquidity there. There's other debt deals, which are debt funds more often than not, that have a ton of liquidity, right? So understanding like how to do the due diligence and how to understand that, we'll touch on that just a little bit. That's not really the focus of this presentation, but it is something I love to talk about. So let's get some definitions out of the way before we kind of jump into exploring the alternatives. So debt, right? Debt is generally the overview. If you're in a debt investment, you're looking for something with some fixed returns. You're looking for a fixed income. You're also in a lender position. So if we think mortgages, you're going to be generally in that first position, not necessarily. There's sometimes when you might take a second position, and that's going to be a strategic choice. But it's a fixed interest rate, right? You know, I'm loaning this to you for 10 years at this percentage. And you know out the gate, like maybe you get a part of the points that they're paying up front, right? You get your percentage of that. If they don't make the payment, then your first position, you're foreclosing, you not directly, but the investment you're in is foreclosing on the house, you're getting your money, you're fine. If you take a second position, it's a little bit more complicated. We can get into that if someone's interested. Equity, you don't have a guaranteed, this is what we're getting, right? There's more upside potential. So even if you're in an equity deal that has a pref, it is less guaranteed and there's still the upside potential. So you have a 6% pref or you have an 8% pref, but then you get a percentage at the sale of that property. Or you're in an equity deal that doesn't have a pref and then you're going to have a much larger upside, right? You're betting on kind of the long-term growth of that. Liquidity, this is going to be your ability to move that money out, whether it's because you need it or because you want to reposition it to somewhere else. So can you get the money? What are you giving up to be able to get that? Is it income focused or is it growth focused? And there are some which are kind of an in between, right? So when I see something and I'm like, oh, that's an income focused deal, it's generally going to be something that really doesn't have a lot of growth in it. There's not a lot of upside, but you know what you're getting. I get 10% every year paid out monthly or paid out quarterly. And when I exit, I just get my money back and I walk away, right? But there really isn't that upside. If you have a growth focused, you're maybe getting 3%, but there's a huge upside. You're getting nothing, but there's a huge upside. You know, it could be a mix. You're going to get 6% and you're still getting some upside potential at the exit of that deal. So the overview of like the main asset classes we will talk about. This is not an exclusive list, but let's kind of all be on the same page. We have real estate. There is so much under real estate. We'll get into that. Equity, technically every debt is either a debt deal or an equity deal. That is why I have this kind of that we went over it first. But when I refer to equity as an asset class, I'm talking about like private equity. So if you want to get in to a business and you're getting private equity in that business, right? That's going to be, I'm buying equity, there's really no returns, and then I'm betting on the growth of that. Tech, you want to get in on some new tech development. Debt, this can be anything from mortgages to other kinds of collateralized or non-collateralized debt. Obviously, stocks, this is going to include your stocks, bonds, mutual funds, and then hedge. So hedge is going to be any of those things that are kind of your hedge against inflation or your hedge against the downside. So oftentimes people will have gold in their portfolio as that hedge against inflation or de-dollarization or whatever you want to call it, whatever your reasoning is. Some people say they get into crypto as a hedge. There's other things that maybe you're going to be not so correlated and you might use those. So let's go more into real estate. Generally in a real estate deal, you either have a value add or you have a development deal. So this is not necessarily just in like multifamily. It can be, but it can also be in self-storage. So let's talk self-storage. You can have a value add. So they're going to go in and buy an old self-storage facility and make some repairs, add some cameras, throw some paint, add the digital key entry, electronic payments. And so by doing these things, you can increase the value of it. You can bring in more tenants, you make more money. 3 to 5 years, they're selling it, you get your money back, you're out. You can do it with multifamily. It's really common there, right? You buy a property from the 70s, replace all the ACs, renovate, add a pool, all the electronics, allow, for electronic payment, these things, 3 to 5 years, 5 to 7 years, and you exit. Development deal, going back to that self-storage, it may not make sense to refurbish an old one. Maybe that area does not have a climate controlled and there's a good demographic that would utilize it. So it's going to be cheaper to build a new self-storage facility than to try and get an old one and refurbish it and add all the climate controlled. So that would be a good opportunity for a development deal. Hospitality is another area, right? When you are looking for a hotel and you see one and you look at the pictures and you're like, oh, I can see the wear patterns on that carpet, right? Okay, well, that could be fixed with a renovation. But then you're going to look at that picture and you're going to be like, I can see, oh, I don't see those wear patterns anymore. I might stay there, but it just looks old. The construction looks old. You can just tell that it's an age. It doesn't have all of the amenities you expect from a decent hotel. And then you see one 2 blocks away and it has these amenities and it has the on-site restaurant and it has a pool and the construction is modern. And you're like, oh, I'm going to pay $10 more and I'm going to stay at this new one, right? So here's an opportunity where it makes sense to do a development deal if the demographic, if the location kind of dictates that. So with value add, you are generally getting returns sooner, not always true, but oftentimes, unless it's a really, really heavy value add, you're going to see some returns sooner. And you kind of can hopefully know a little bit more what you're getting into going in, right? With a development deal, there's more unknowns. This is really where you want to lean into those contractors that have the experience so they know how to plan for the unexpected because they've done it enough times, and that can offset a lot of that risk and put it kind of more on the same level as a value add deal. So private equity, this can be anything from consumer products, tech, services. There's a whole variety. This is really going to be a growth play in your portfolio because generally a good investment in private equity is not going to be a fast turnaround. This is not something that you're getting into and you're expecting to double your money in 3 years and get out, because there's a lot more moving parts and there's a lot more that's just unpredictable. It may be structured where you do get some returns, as it starts, the business becomes cash positive, or the tech company, starts to get more clients, you can see something, or you may not, right? That's going to be all in the structure of the deal. But it really is generally a longer hold. So if you're in retirement, you might use this as like a legacy play rather than I'm going to grow my portfolio so that I can go buy a car, in 5 years. And then debt. We talked a little bit about this. Debt is across all sectors. So in Sequoia Fund Group, we have had debt opportunities that were in the real estate sector. And so that's going to be like those mortgages. We have debt opportunities that are not in real estate. They still have all of your classic kind of debt things. You know exactly what you're getting. No matter how well things go, you're getting your return. I'm a big fan of collateralized debt because if something goes wrong, then there is something tangible there you can sell off. Generally, you're going to see monthly or quarterly cash flow, and the the hold periods can be shorter. So this is not always true. Oftentimes you can get better returns with a longer hold, or you have really short holds and you get really high returns if you're doing something like a bridge loan. So let's go back and talk about referencing kind of that stocks, bonds, mutual funds. So everyone has probably heard of like the 60-40 portfolio, the 80-20. And so this is sort of your classic recommendation for how you should diversify in the stocks and bonds. The idea being that you can take more risk earlier. Now, I personally do not agree with this. If I was in my 60s, I was looking to retire at 65, I would not want to be 60% in stocks. I would want a lot more stability. But this is what I found on the Charles Schwab's website, right? So this is their recommendation. This is not mine. Hold this, screenshotted it. This is their recommendation because I wanted to talk about it in terms of, hey, what does this look like if you're like me? And you said, but I want more stability. I want some predictability. I want to be able to make a plan. I don't want to just hope that the sentiment of the general public or the institutional investors is such that I can afford to retire or buy a new car or go on vacation. So what does that look like if you have sort of an income focused portfolio, right? So you're in your 20s to 40s, you're growing, you're in that accumulation phase. Here, you're going to want to be more in the growth. So this is going to be things like having a little bit heavier in the real estate, in the private equity, in these things that aren't giving you those stable quarterly returns, but do have much better growth opportunities, right? So you're in real estate, you're expecting to almost double your money in that 5-year hold. You're in private equity, you have every reasonable expectation of doubling your money within 5 years. And then you want some stability and some income on it, not because you're taking your income at this phase, but because the income is what allows you to pivot and to diversify when you see new opportunities, right? So you can take that income and oftentimes, depending on the investment, either reinvest it, or when you see an opportunity, you can put it into, just into a cash position or into a kind of a liquid low interest earning kind of position, and then be able to pivot and those are going to be your more liquid positions as well. And then you want to have something for a hedge, right? So if you're a Bitcoiner, you're buying into Bitcoin. If you are a gold bug, you're buying into gold. If you're somewhere in between, maybe you're buying both, or maybe you're not really, but you've just looked at the numbers and you say, I want to add some gold to my portfolio, and it's going to be a small amount because I want to have it there so that it can start accumulating the value. Then you start pivoting. You want more stability, you want more growth. So now as you're exiting, right? So now you're in your 40s to 60s. This is really dependent on when you're wanting to retire. And you're thinking, okay, well, I'm going to need income in the next 5 to 10 years. I don't want to be all in real estate. I need to add a little bit more stability and income potential, right? So you start pivoting more into those stable, more into those liquid returns. And then you're fully in retirement now, right? You're in your 60s to 70s. If you're not retired yet, great. But whenever you hit that point, you're going, more. Oh, I forgot to change these numbers. You'll see the highlighted ones were the ones I had to go back and do math on. So 60s to 70s, 70 plus, right here, you're getting more into really being heavily income focused. Don't pay attention, listen to my words, and that was on that slide. And so I have clients that are in their 70s and they have a small portion of their portfolio that's in growth. And it's for two, they kind of have one little bucket that's their legacy play. And then they have a little bucket that's a more kind of solid 5-year. We know it's a pretty clear exit. We're not getting into big deals that, don't have really strong exit plans or have maybe less predictability in the market. And those are going to be there. I'm going to need to buy a new car or make major house repairs. I'll need a new roof here in a few years. But it's really, really heavy on the income because that's what they need. So I want to do a little bit of an exercise. And And so let's kind of go over some liquidity, and then let's talk about building out a portfolio and looking at from this 30,000-foot view and saying, hey, am I diversified in terms of asset classes? Am I diversified in terms of growth mechanism? Am I diversified in terms of liquidity, geographic location, all of these things? So here's just sort of an example, right? So a debt fund, we're looking at liquidity. These are rough percentages of what you might, if you said, I want to be in everything, put me in all of it, right? Here's what we're looking at, and we can kind of break down what that might look like. Industrial and retail, initially right off the bat, a lot of people are like, count me out, right? Everyone's working remotely. Who goes shopping? Everyone uses Amazon now. But there's still a big place for it because there are some things that you have to go into a store to buy. Or you're in the industrial because Amazon needs warehouses. You're in the industrial space because AI requires really big server farms, and that requires warehouses and industrial zoning. Or you're saying, well, I'm going to get into a niche because there are some things that require that physical location. And so I live in Texas. I'm actually currently in Oregon visiting some family. And here there is recreational and there is medical cannabis. And that is something that is heavy on the retail. You want to go in, you show your ID, you're getting verified. And then you're looking at the products and you're looking at the physical flower and you're looking at the packaging and you're talking to the people and you're picking out your product, right? I'm not going to Amazon for that. So I'm not going to the store either, but someone who is interested, my father is not going to Amazon for that. So, okay. And then the real estate, single family homes, this can be a whole variety of like, maybe it's a diversified fund or like a group fund that's going into these things. You can get into equity on that. This can be liquid or illiquid. I have it marked as liquid here because the investment opportunity we have currently in Sequoia Fund Group that is in the single family home sector is a very liquid investment. Most of them are not, right? So don't think, oh, because it's single family homes, it is. This is a pretty unique opportunity to have that much liquidity. But in this case, based on what I am currently offering clients through the fund, there is a lot of liquidity there. Gold, this can be a little bit tricky through an IRA. There's a lot of things you need to take into consideration. You're not making a phone call and having it shipped to your house. You can if you're paying cash, but not if you're doing the IRA. There's a few different options, but that's like its own conversation. So we're not even going to talk about it. We'll just mention it's there. And depending on how you're invested is going to impact the liquidity. But I say that it's semi-liquid because you can decide I need to liquidate a portion of this part of my portfolio, and you can sell that gold. And so it's not going to be instant. You're not getting it necessarily in the next 30 days. You're not getting it in 60 days, but it is more liquid. You don't have to wait until like your 5-year exit point. Self-storage, this can be, depending on how the deal is structured, semi-liquid. We have a deal that we'll be entering here in the next couple of weeks. We just finished the vetting process. And so we'll be bringing it into the fund. And it is technically not liquid, but it is a mix of, it has a lot more income focused than most self-storage deals that are either like a really just an income or a growth. And this is a mix. So build for rent. This is going to be kind of similar to the single family. Again, semi-liquid in that it's going to be a shorter hold time, or the mechanisms for being able to exit are going to be different. Multifamily, generally in these deals and in the current deal that we have available, it's not liquid, right? You're getting in and you're in for that 3 to 5 years. Development deal, same thing. You're getting in on the ground floor. You get your money out. You have options of getting your money out at the refinance or holding it, and turning it into an income generating opportunity. Same with the tech opportunities, because that's really an equity investment. So let's break down when we talk about real estate. And you say, well, I want to have some, I really like real estate. I like the fact that it's a tangible asset. There's something I can fly out to my property and I can look at it. And if something goes sideways, there's a thing to put a for sale sign, right? So here, we still want to make sure that we have some diversification. So when I think about it, I'm thinking, well, there's the housing. So even though in some ways these are going to be different, like technically the multifamily is commercial when you're going for that loan. When it comes to like how that sector is doing, are people paying rent? Are people paying their mortgage, right? The multifamily and the single family, those were being impacted very similarly during COVID. Commercial, this is going to be your self-storage. This is going to be offices. This is going to be retail, industrial. These are going to tend to be a little bit different in that you're going to have much more long-term tenants in something like an industrial or a retail space. They're signing that 5-year lease. Self-storage, they're signing a month-to-month lease, but the number of tenants per building is so low that if one leaves, it's less impactful. And honestly, when the housing market is suffering, self-storage is doing well because people are moving, people are downsizing, right? When things are not going so well and everything else, this is a great place to be. When things are booming, you see a lot of business startups and they tend to use self-storage as a place to store things so that they don't have it in their house while they're starting their business. So it doesn't do as well as in bad economic times, but it really is kind of a hedge. So I would not put it under the housing in any way, shape, or form, even though it's, kind of direct consumer. And then real estate debt. You have the residential, this is those mortgages, you have commercial. And then, so this is going to be like those loans on those commercial properties. And you have short term, this is going to be those bridge loans. This is going to be when that multifamily property needs to close, but they don't have enough money for that loan. So you're going to give them a 60-day loan at a much higher interest rate so that they can finish bringing in their investor capital and be able to close on the property, but they are able to hit that close date. And then debt, so you have collateralized, non-collateralized. If you really believe in something, you can go into non-collateralized. This is really going to be bulk as like commercial or a retail. Retail is going to be, I'm going to go and I'm going to make these personal loans, right? There's platforms out there, peer-to-peer lending. You might go and you might do these peer-to-peer loans. If they don't pay it back, well, then you don't get your money. And yeah, it can get sent to collections and, maybe you get pennies on the dollar 5 years later, but it really, there's not a lot you can do at that point. Commercial is going to be, that business loan that they're saying, oh, well, I promise I'm a good business owner and I need a loan so I can make payroll or I can expand my business or whatever it is. But there's not a thing that you can put a lien on. And then the collateralized, the real estate, this is title, maybe equipment loans, things like that. And then everything else you can think of that has a thing you can put a lien against. Private equity, this is going to be venture opportunities. So this is going to be like that startup business that, we're adding this, whatever it is, these venture opportunities. And then expansion. So there might be an opportunity where there's a business that's saying, hey, I want to expand my operation from, Texas and Louisiana, and I want to go all the way to Florida. And here's our track record, but we need money to be able to expand our business operations and cover a larger territory. So you can get in on that. So that's more of an existing business that's expanding. And then other, this is going to be like gold, it should say gold, silver, crypto, legal finance. There's, ways to get into that. We're not going to talk about it. If you have interest, like reach out to me and let me know. We're currently doing some vetting and investigating to bring something in that world kind of realm into the fund. So I'll put you on the list to know when that comes available if you're interested. It's just a really fun opportunity that's pretty unique in terms of having in people's portfolios, but it is not coupled to your traditional markets. So here's kind of this wheel so that we can look at, right? This is a bit of a pivot, but now we've gone through everything. So let's talk about building out that portfolio. So if you take and you put in this outer wheel, hey, I'm going to get a visual and I'm going to start looking at what do I have in terms of liquidity? What do I have that's income based, right? Let's list them all out. And then using the green, this is going to tell me how is this income producing, right? Even if I'm turning around and I'm reinvesting it, or I'm taking it and I'm funding into something else, I'm using one asset, the interest to grow my next one. And then maybe you get near retirement and you turn it on and it becomes an actual income stream. The yellow is going to be semi. I spoke to that earlier, that it is, it's producing a lower return than everything else, maybe about half of whatever the income producing ones are. But and it has some upside potential, but it is still an income producing. So you're looking at, 5-6% return there that you're getting, annually versus that 10 to 12% that you're looking at, for your income focused. Same with gold. Generally, this is not considered income producing. We are currently exploring an option that would allow it to be slightly, right, allow you to grow it a little bit more than just the hold technique. So we'll see. We're in the vetting process there. And then multifamily, right? Really not an income play at all. It's a growth play. And then in this inner circle, looking at liquidity, it's not liquid. Multifamily, it's not liquid. Tech is the same thing. Not liquid, no income. So you want to make sure now this wheel is, equally spaced. But if you just look at this one, you can say, well, look, I don't have too much here that's illiquid and non-income producing, right? These are my growth plays or my legacy plays. That's okay, right? I've got two pieces of this pie. Here I have some liquidity and some income, liquidity and income, liquidity and income. That's great, and then a mix of kind of the in between. So depending on where you are in your journey, you might sketch out how much of this pie needs to be liquid, how much of it needs to be income producing, and then that will dictate kind of how heavily you need to be in each asset class. So Q&A time.
All right, good stuff, Ada. That pinwheel was interesting because it kind of, you talk about diversification not only in asset classes, not only in investments within an asset class, but also that balance of income producing versus long-term equity. That was a good way of looking at it.
You can't capture it on the pinwheel in the software for the fund where you log in and look at your portfolio. There's a feature that you can look at if you're doing like things like property that have an address. You can look at geographic, which is not something that captures, but is important if you're heavy in like the physical assets.
Right.
Which is also another way of looking at it.
Yeah, it was a great way of looking at it. Yeah, there are some questions. First, with regard to due diligence on this kind of stuff, it's a big topic around here. Self-direction means that you have to do your own homework, and the idea that people spend more time planning their vacations and their retirements is a big deal here. But a lot of people don't know how to do it. I know as much as I've rattled around this area, I am learning all the time on how to do due diligence. Just a few pointers from you in terms of go, no go essentials. Like what are deal killers and red flags, for example? When the things that you look at, what do you look at?
Yeah, so I will tell you, I think it's an amazing topic. I could speak for an hour on it. Yeah. The top line, right? So when a deal comes to the fund or we meet someone, like I can tell right off the top if it's worth a second conversation. And that's going to be, hey, if we're talking debt, is it collateralized? I am not investing in non-collateralized debt.
Okay.
I've done it once in my life, and that did not work out well, right? I would never want to bring that to an investor. I have had opportunities that looked promising, and I said, hey, how are you collateralizing this? Well, we'll keep some money. No, 5% of what I'm loaning you in a bank account that is not collateral.
No,
So
reserve
that
is
right
not
there,
collateral. Yeah. Yeah.
your reserve is not collateral.
Yeah.
So I would never, if it's debt, I would only look at collateral. I also look at the time in kind of that sector. So my rule is 5 years of experience and having exited at least one deal. Now, one deal feels kind of low, but you have to think if we're talking multifamily, that means they've been in for 5 years. They bought a property, they made a bet on it, they did their thing, and they sold it. So if out of the gate they're doing that and they're doing it well, and I can see those numbers and I can see those returns, then I know that they're bringing on mentors, right? No one is probably doing that without some help. And you'll see that on multifamily deals where you'll have your sponsor and then you'll have the co-sponsor that has 25 years of experience. And so the other thing is the years of experience. So there are some people who their years of experience may not be in that same fund, right? So this fund is 3 years old. This investment fund that we're going into is only 3 years old. But then you look at the people that are running it and you say, oh, they have 15 years of experience running funds, managing investment portfolios. So their experience, while the fund is only 3 years, their experience is more, and they've gone into and out of multiple deals. So they've exited deals, right? You can see it, the full cycle of that investment. To me, that's super important. I want to see the full cycle, whatever it is, if it's debt, if it's equity. Now that's harder to do if you're looking at something like tech, because you're going to have someone who has done some big tech projects and now they're coming up with this new product and they're working on it. Well, that's where you're going to have to use your judgment and say, okay, here's someone that has 20 years of experience in a very similar kind of tech world. They understand how to do this technically. They understand the needs, they understand the pitfalls, right? So maybe they haven't exited like this, a startup in the AI space, but they've been heavy in tech. So I want to see the experience. I want to see the exits. Those are my big red flags. If I'm not seeing those, we're not even having a second conversation. After that, then we go to the second conversation. And that second conversation is more deal specific. That's where we're looking at the specifics of the deal. We're looking at the specifics of their track record. We're asking them, what's the worst deal you've ever had? What happened with it? What's the best deal? Why was it the best deal? And then we're looking at their numbers, right? So the development deal we have is a hospitality deal. And this one is, so it's a new build hotel that is in a position to be able to serve both winter and summer tourism and to serve it's in California, so they have a lot of infrastructure that needs to be rebuilt after the fires. So there's the Caltrans location there. There's a prison nearby, the courthouse that serves predominantly that prison, and then one other state agency that's doing rebuilding, whatever, is working in that area on a 10-year contract. So like, okay, great. This deal looks good, right? If we see another COVID, we're still going to see people needing to go to court, needing to visit their loved ones or be near them. We're still going to see people, we're still going to see work on the power lines. So I feel good about that. And then I go to looking at that actual sponsor, right? I want to see the numbers. And we did it back and forth going into, okay, so you put this, what happens if the cost of steel goes up? Show me what the numbers look like if you do that, and getting some of that feedback. So looking at really very detailed specifics. Depending on how you as the investor are entering it, you may not have as much access to ask all of those deeper level questions. I make as much of that as I possibly can accessible to investors, right? There's kind of the top level people want to see, like, give me the numbers. Why does it make sense? What's the return? What's the hold time? What are the risks? And then there's some people who say, I want to see more. And so I have that available to share, because, some people want to deep dive, some people want to kind of look at it and then just make a more of a base, or they look at the person's experience and can make some assumptions based off of that.
Right. Excellent answer, because it covered not only that division between the jockey and the horse, and so you've got experienced jockeys, done his or her deals in the past, has been in the space for a significant period of time, has had successes, can diagnose and dissect the failures that they've faced, and then there's the actual horse or the asset class itself.
Yeah.
Is it a hot asset class? Is the specific asset viable within that class, and a market conditions conducive, and then, as you pointed out, doing stress tests. So those of you who are a bit have some trepidation about doing due diligence, Ada and her partner would, this is the kind of Sherpas that might help you get into
Yeah,
these
I would
things.
say, like, if you're new to this space too, and you're thinking, man, I don't know what questions to ask.
Right.
I'll kind of touch on it at the end of the Q&A, but I would reach out to me and let's connect, because one of the things we do for investors, beyond just making all the information available, or some people want to, they want to do it themselves. I want to come in, I want to vet it, I want to make my decision. But some people aren't, because they just don't have the experience. And so I will call and I will sit with investors on Zoom, and I will sit with them on the phone, and we'll go over, okay, what if this? Well, what questions am I forgetting to ask? Here's what you're forgetting to ask, right? I have a multifamily deal right now that I was looking at the numbers, and it looks great. I mean, there's so much to love about the property. It was a single owner for 20 years. He loved it. It was great. And then his estate got it for 2 years, absolutely did a terrible job managing it. They were so money hungry. So he got it at an amazing deal, because they had to liquidate. The trustee was like, I'm over this, right? And I'm looking at the numbers and I'm like, wow, these are great returns. There's really not all that much that needs to be done in terms of value add. There's a refinance at year 2. Whoa, listen, like, I'm backing away from this. Like, I don't like it. I've seen people get burned because interest rates went up. So what happens? What happens if we see interest rates double? Well, and then he was able to show me, right? Hey, this is what happens. The returns aren't as good, but they're still good. They're just not great. Okay, I'm back on, or I'm back into the conversation. But when I first started in this space, I didn't know to like catch that refinance, and that should be a really big red flag. And then I talked to people who were like, I got burned on this, and I was like, oh, I'm going to learn from your mistake, right? Didn't take long, and I learned that lesson. So yeah, if you don't know, just reach out to me. I'll put my contact up here in just a second. If you don't know, then reach out. Let's have a conversation, and then I can help you kind of do vetting and all of that.
Yeah. We've got a question here from Kenneth, and it was a question I had too. Just walk through, how much do you have in the fund? What is the entry and exit process? Minimums, all that kind of stuff. Can you walk through that?
Yeah, that's a really good question. So, I didn't really hardly get into this. So Sequoia Fund Group is a customizable fund. And what that means is that you come into the fund, and it's kind of like a marketplace. You get to choose where within the fund you're allocating. So I am not deciding how much is real estate, how much is debt. I am putting it all available. I'm putting it all on the table. And then you are choosing, I want my 100,000 to be 50% in real estate. I want to go into these 3 real estate investments. I don't want to go into that one. And I want to go into this debt investment and this tech investment, right? So you're making those choices for your money. So in terms of the minimum and what's managed, it is ultimately all about what those underlying sponsors are. So I am not the direct sponsor on any deal. I probably will be at some point in the next 20 years, but right now, I want to bring really solid quality deals. And I do that through a lot of networking and a lot of vetting, and just building a platinum Rolodex. So the question at that point should be, hey, I'm interested in this deal. How long have they been in business? How much are they managed, right? Because one of them is a lot smaller than the next one. One of them has been in business for 10 years and one of them has been in business for 3 years. So great question, but it would need to be a one-on-one conversation so we can talk about the specific deals. In terms of the entry and exit process. So the minimum to get in to the fund is 25,000. There are deals within there that have lower minimums. Most people end up putting more because when you put in 25,000, there's not a lot you can do with it. But if you want to get your toes wet, that's why I set that so low. Because I said, you know what, if you're just entering into alternatives, you might not want to put very much, and that's okay, right? Try it out, see how it feels. And then I don't know if fees were a part of that, but it should be. So I'll answer it anyway. So I am committed to ensuring that if you come to a deal through Sequoia Fund Group, that you will not get a worse deal, a worse return than you would by going directly to the sponsor. My goal is not to kind of trick you and get rich off of it. My goal is to actually bring you a better opportunity. So what I do is either worst case scenario, it's exactly the same. And the advantage to you is that you can move your 100,000 over. So now you're paying one $30 wire fee. Your $100,000 is moved over and you can put it into 5 investments, right? And so the cost is then, and then you want to take twice a year distributions. And so you can get your money, you can put it into our sort of cash position. And then again, you're only having that transfer happen, less versus if you had those 5 investments individually. So worst case scenario, it's a little bit better because you're saving on fees and you're saving on K1s and headaches. Best case scenario, we do have some deals that we've negotiated better returns. So if you come to the deal through Sequoia Fund Group, you are getting a higher return than if you went to the sponsor directly.
And this is a great way. What you've done is aggregated resources, aggregated funds.
Yep.
To place into these things. And, when you come in at the levels that you're coming in at, generally the sponsors will give you a break and you're
Yep.
passing that along. So that's
and
good.
I'm passing that. And each deal that any kind of fees associated are going to be disclosed in it. But generally, if there's a fee to the investor, it's going to be, hey, if you went, that's like they're paying us 12% and giving you 10%. If you went to them directly, you'd get 8%. So yes, you're paying a fee, but you're ending up ahead than if you didn't. So, but that's also on a deal to deal. There's disclosures for each deal that you get to analyze what you're comfortable with.
And that other point about bringing over funds and allocating it across different investments, that's pretty good because again, you would normally be incurring separate wire fees or ACH fees to do that. Do you have on the cash portion of the holding, is there an interest bearing?
Yeah, it's
that's nice.
I want to say it's like 3. I haven't looked at it in the last couple of months, but it's in the 3-ish range. So it's okay. Kind of in line with not as high as the highest high yield, but your sort of average run of the mill high yield. That's what you're going to get.
Very good. Very good.
Yeah.
So the fees are a la carte, or the investments are a la carte. We've walked through that. This is a great way to get exposure to it. You've got, a couple of Sherpas in place, at Sequoia. To get the final answer in Kenneth's questions, what's your AUM today? Are you at liberty to disclose?
So I think, how we have brought into the fund about $1 million so far.
Okay.
We have been, the fund itself, Sequoia Fund Group, has been in place for about a year. The investments I have been working with individually. So before I started, I didn't talk about this either. So before I started this fund, my partner and I just worked with clients directly on diversifying their portfolios. So I've worked with these investment opportunities. Most of them I have worked with for a lot longer, and in helping clients go directly into them. So I have years of experience in working with the kind of our core investments in it. but within the fund itself, not, we're about a year old now.
Okay, then you're working probably with some funds that require you to be accredited. William wants to know if he needs to be accredited for you guys.
So yes and no. You have to be accredited for Sequoia to enter into Sequoia Fund Group. However, not all of the investments in the Sequoia Fund Group require you to be accredited. So if you are not accredited, reach out to me, because I cannot advertise those deals. But if you reach out to me and say, hey, I liked what you had to say, I'm interested in different opportunities, and we have a conversation, then I can spill the beans. I'll share everything with you. Right. And move quickly if you're interested, if you're not accredited, because there is a limited time opportunity that's coming up within this month. It'll be opening for non-accredited investors, but it's not going to be open for a super long time. So reach out, I'll get you the information. If you don't love it, don't invest. And if you do, then we'll meet, we'll go through all the due diligence together, and you can get into that opportunity.
That sounds good. And then Stanley has an LLC in his self-directed IRA. Does that change the dynamics of investing with you? Okay.
Not at all.
All right. Stanley, I hope that answered your question. William, same to you. And Kenneth and James, thanks as always for sitting in. This has been really good stuff. So you got a smorgasbord of opportunities sitting at the other end of this thing, and you've got two Sherpas to help guide you through it. And I'd say get in touch and start the conversation.
Anyone who's interested, if you drop your like a name, say info, whatever, so that I know, I'll reach out to you. I did put my direct cell phone. That's going to be the best way. Shoot me a text. That's going to be the best way to get a hold of me. You can call as well, but I respond to texts a lot faster. I have 2 little kids. So I can respond wherever I am. And then the general phone number is there, but it's the worst way to get a hold of me. So email or text is going to be best.
All right.
Yeah,
Ada,
I'd love to talk to people and share more info.
Thanks so much for your time today. And thanks everybody who sat in, and hope you got something out of it. I think I did. And anyway, join us here next week. We'll have another topic to talk about. And Ada, thanks again. Have a great day, and have a great day, everyone.
Yeah, thank you so much.
Bye-bye.
Bye.